Today we're answering the question at hand. How long will my retirement savings last? By the end of this video, you'll learn the critical factors that determine how long your retirement savings will actually last. Why the traditional 4% rule is outdated and may not provide enough income. The limitations of traditional retirement accounts in today's low interest and high inflation environment. And an alternative strategy that can provide reliable, growing income streams for your retirement. They say the number one fear of keeping Americans awake at night isn't death, disease, or disaster. It's actually running out of money in retirement, and that fear is completely rational. Most people have no idea how long their retirement savings will actually last. They're playing a dangerous game, guessing what their financial future looks like. But today, we are diving deep into the science of retirement planning, revealing the uncomfortable truths about how long your money will really last, and most importantly, what you can do about it, right? Here's the deal. The thing about retirement planning that most people get wrong needs to be revealed. It's not just about hitting some magic number in your account. It's about creating sustainable cash flow that can support you for potentially 30, 35, maybe even 40 years. Think about that. We're talking about making money now to last longer than most people's entire working careers. Now, before we proceed, first let's break down the critical factors that determine how long your retirement savings will actually last. First, we need to understand the famous 4% rule. This guideline suggests that you withdraw 4% of your retirement portfolio every year, adjusted for inflation, without running out of money. Sounds simple, right? Here's where it gets a little tricky. The 4% rule was created 30 years ago based on market conditions that simply just don't exist anymore. Back then, bonds were yielding double digits and the stock market was entering one of the greatest bull runs in history. Today's reality, well, it's a little bit different. Let's look at some real numbers. Let's say you have $1 million saved, which sounds impressive. The 4% rule means you can safely withdraw $40,000 in your first year. Adjust that for inflation each year, and that's what you have to live on. But here's the problem. The average American household spends around $77,280 annually. Get it? You see the disconnect? But it gets more complicated. You see, the 4% rule assumes a 30-year retirement time frame. With people living longer than ever before, many of us need our money to last 35, 40, I've even heard as much as 50 years. The math changes dramatically when you extend that timeline. Now, according to recent research, if you want your money to last 40 years, you might need to lower your withdrawal rate to 3% or even 2.8%. That means on that same $1 million portfolio, you're looking at just $28,000 to $30,000 per year. Factor in inflation and your purchasing power shrinks every single year. Another critical factor most people overlook is that spending patterns in retirement aren't linear. There are typically three distinct phases. Number one is the go-go years of early retirement. This is when spending is highest. You're healthy, active, traveling, pursuing hobbies, often spending more than you did while you were working. Number two is the slow-go years or middle retirement. Activity levels and spending naturally decreases in this phase, but medical expenses start creeping up. And finally, we have the no-go years or late retirement. During this phase, the overall spending might decrease, but healthcare costs often skyrocket, potentially consuming 15% or more of your retirement budget. Your retirement savings need to weather all of these phases while dealing with market volatility, inflation eroding purchasing power, rising healthcare costs, unexpected expenses, changing tax rates, and potential long-term care needs. So this is why the traditional approach of just saving money and hoping it lasts doesn't work anymore. You may need a more sophisticated strategy. Now, one approach gaining traction is what financial experts call dynamic spending. Now, this means adjusting your withdrawals based on market performance, taking out less when markets are down and a bit more when they're up. Studies show that you can increase your portfolio's longevity by about 10 to 15%. But even with dynamic spending, the fundamental problem remains, which is the fact that traditional retirement accounts were designed for a world that no longer exists. a world where people retired at 65 and lived to 80, where pensions were common and Social Security could cover basic needs, and a conservative investment portfolio, well, that could generate reliable income through bonds and CDs. Today's retirees, well, they face a very, very different reality. The Social Security benefits are covering less and less of retirement needs. Pensions are virtually extinct in the private sector. Back when interest rates were at historic lows, generating meaningful income from safe investments is getting harder than ever. So what's the solution? Pensions are virtually extinct in the private sector. So what's the solution? While most financial advisors are still pushing the same old playbook, the one of stocks, bonds, and mutual funds, a growing number of savvy investors are turning to alternative strategies. But first, let's look at what traditional financial advice tells us to do when it comes to our retirement and the upcoming crisis. Now, the standard recommendation typically fall into three categories. First, they'll tell you to save more. Much more. Financial institutions now recommend having 10 to 12 times your annual salary saved by the time of retirement. For someone making $100,000 a year, that's $1.2 million. But what they don't emphasize is that even that might not be enough. The second piece of advice is to work longer. Right? You know that guy ringing the bell at Walmart? Every extra year you work is another year you're not drawing down savings, plus another year of potential contributions. But let's be honest, working until we're 70 or 75 isn't what most people dreamt about when they thought about their retirement, right? Now, the third suggestion is usually to reduce your expenses. The famous 80% rule suggests you'll need about 80% of your pre-retirement income to maintain your lifestyle. But this rule of thumb ignores a crucial reality. Yep, healthcare costs typically increase by 15 to 20% in retirement. That potentially wipes out savings from reduced spending in other areas. But there's an even bigger problem with these traditional solutions. They're all based on the same flawed premise that the only way to fund a retirement account is through gradual accumulation and careful depletion of savings. Think about this. When you rely solely on withdrawing from savings, you're constantly fighting a mathematical battle against time. Got it? Every market downturn becomes a potential disaster. Every unexpected expense eats into your future security. And worst of all, you're always wondering if your money will last. What if, instead of focusing on how to make our savings last longer, we asked a different question, one that's totally different? What if we focused on creating reliable, sustainable income streams that could potentially grow over time? Well, this is where alternative investment strategies come into play, and specifically why many savvy investors are turning to multifamily real estate investing as a retirement solution. But before we dive into that, let's understand exactly why traditional retirement vehicles are becoming less reliable. For one, there is market volatility. The stock market's ups and downs can devastate retirement accounts, especially early in retirement. A significant market crash in your first few years of retirement, well, that can permanently damage your portfolio's ability to provide lasting income. Secondly, traditional retirement planning relied heavily on bond income. But in today's interest rate environment, bonds barely keep pace with inflation, let alone provide meaningful income. Third, even modest inflation of 3% per year can cut your purchasing power in half over 24 years. Traditional retirement accounts often struggle to provide enough growth to offset this erosion of buying power. Fourth, and this is the big one that most people never consider, even if your investments average good returns over time, the order of those returns matters enormously. Bad returns early in retirement can devastate even a well-planned portfolio. And finally, with increasing life expectancy, your money needs to last longer than ever. A healthy 65-year-old couple today has a 50% chance that at least one spouse will live past 90. These challenges are forcing many people to reconsider their entire approach to retirement planning. The old model of accumulating a nest egg and then slowly spending it down is becoming increasingly risky. This brings us to a revolutionary shift in retirement thinking. Now, instead of focusing solely on accumulation and withdrawal, what if we could build a portfolio that generates reliable monthly income? What if this income could potentially grow over time to help combat inflation? And what if this approach actually became more secure the longer you held it? This search for reliable retirement income brings us to multifamily real estate investing, one of the most overlooked yet powerful wealth building strategies in the market. While traditional retirement accounts leave you at the mercy of market swings, multifamily properties offer something fundamentally different. They generate real cash flow from day one. Think about what happens when you own a multifamily property. Every month, tenants pay rent. After covering expenses like mortgage, maintenance, and property management, that rent translates into steady cash flow hitting our bank accounts. It's remarkably similar to receiving a paycheck, except you're not trading your time for money anymore. Your property is now working for you. But the power of multifamily investing goes far beyond just monthly cash flow. As inflation pushes costs higher, you can adjust rents to maintain your purchasing power. This natural inflation protection is something traditional retirement accounts simply can't match. Now, while your neighbors are watching their fixed income struggle to keep pace with rising prices, your rental income can grow alongside the economy. The tax benefits are equally impressive. The government actually incentivizes real estate investors through various tax advantages. Depreciation alone can help shield a significant portion of your rental income from taxes. This means you could potentially earn more while keeping more of what you make. Powerful combination for retirement planning. Well, what about market downturns? This is where multifamilies actually shine. Even during economic uncertainty, people always need a place to live. In fact, many people shift from home ownership to renting during tougher times, making multifamily properties potentially more stable than other investments. Now, while stock market investors were watching their portfolios plummet during past recessions, many multifamily property owners were still collecting steady rent payments. But perhaps the most powerful aspect of multifamily investing is the concept of forced appreciation. You see, unlike single-family homes that depend entirely on market conditions for their value, multifamily properties have an additional advantage. By improving the property and increasing its net operating income, you can actively increase its value. This means you're not just collecting rent. You're building equity, and that can be accessed or passed on to future generations very easily. Now, the beauty of this approach is that it addresses the fundamental flaw in traditional retirement planning, the constant fear of running out of money. Instead of watching your nest egg shrink with every withdrawal, you're building a perpetual income machine. Your properties can continue generating cash flow while potentially appreciating in value, creating a growing stream of income that could last well beyond your lifetime. Now, you might be thinking this sounds great for wealthy investors, but who can buy entire apartment buildings? But what about the average person planning for retirement? This is where modern investment approaches have opened up brand new doors. Through various investment structures and partnerships, it's possible to now invest in multifamily properties with much more of a modest amount of capital than you could possibly imagine. The key is understanding that multifamily investing isn't just about buying buildings. It's about buying into a system that generates consistent income. Let's look at a real-world comparison. Now, a traditional retirement account with $500,000 following the 4% rule would provide about $20,000 annually. Now take that same $500,000 invested in a multifamily property. A well-managed property could potentially generate not just comparable cash flow, but also build equity, appreciation in value, and provide tax advantages that effectively increase your real return. But what makes this approach truly powerful is its scalability. As you build equity in your first property, you can leverage that equity to acquire additional property. Each property then creates its own stream of income, potentially growing your retirement cash flow over time. This snowball effect is something traditional retirement accounts simply can't replicate. They just can't do it. Consider the timing advantage as well. While traditional retirement planning requires you wait until your 60s to access your funds without any penalties, multifamily investing can start generating income immediately. This means you could potentially build your retirement income streams while you're still working, creating a nice, smooth transition into retirement rather than a cliff edge change. The stability factor can't be overstated. You own multifamily properties, you're not dependent on the whims of the stock market market or the decisions of corporate boards. It just doesn't work that way. You have direct control over your investment. You can influence your returns through better management, property improvements, and strategic decisions about your tenant base. But what about the practical aspects of managing property? Well, this is where many people hesitate, imagining themselves fixing toilets at midnight or dealing with difficult tenants. The reality is that professional property management has evolved significantly. For a reasonable fee, professional managers can handle all of the day-to-day operations, making your investment truly passive, while you focus on the strategic decisions that drive long-term value. The path to getting started in multifamily investing is clearer than it's ever been before. You don't need to start with a massive apartment complex. Many successful investors begin with smaller properties, learning the fundamentals before scaling up. Others participate through investment partnerships or real estate investment groups, pooling resources to access larger, more stable properties than they could acquire individually. The key is understanding that this isn't about getting rich quick or making risky speculative bets. It's about building a sustainable, reliable income stream that can support you through decades of retirement. Think about the peace of mind that comes from knowing your retirement is no longer dependent on hoping your savings will last long enough. Instead, you've built a system that generates ongoing income, protects against inflation, and could potentially provide growing wealth for generations to come. The choice becomes clear when you look at the long-term picture. You can stick with traditional retirement model, constantly calculating withdrawal rates and hoping your money lasts, or you could build a portfolio of income-producing properties that work for you year after year after year. The first approach leaves you hoping you have enough. The second puts you in control of creating the income you need. This is why multifamily investing isn't just another investment strategy, it's a complete paradigm shift in how we think about retirement security. Instead of asking, how long will my retirement savings last? You can focus on building and growing your income streams. The question changes from, do I have enough, to how can I grow my monthly cash flow? The time to start thinking about this approach isn't when you're ready to retire, it's now. Every month that passes is another opportunity to begin building your real estate portfolio and start growing the cash flow that could one day replace your working income. The sooner you begin, the more time you have to let the power of real estate work in your favor, creating the retirement security you and I deserve. Think about where you want to be in 5, 10, or 20 years. Do you still want to be worrying about market volatility and withdrawal rates? Or would you prefer to have built a portfolio of properties generating steady monthly income? The choice is yours. Your retirement years should be about enjoying life, not constantly calculating if your savings will last. If you're ready to learn more about how multifamily investing can transform your retirement outlook, click the link in the description below. I've put together an additional resource that will help you get started on your journey to building real estate wealth. Remember, knowledge is just the first step. Action is what transforms your financial future. And if you got some value out of this video, please be sure to like, subscribe, and also click the bell so that you get notified when I post new videos. I'll see you in the next video, and you can access it right here.